Alrighty. Good morning, folks. This is Mitch Firestone with Precision Trading Labs in New York City. It is March 4th, 2025, and this is the live trading session. Before we get going, the usual disclaimer: we are not money managers, financial advisors, all that jazz. Everything is for educational purposes only, and more importantly, we're here to help you guys acquire mad trading skills. Alrighty. So a couple of things here today. I'm going to do a little market analysis here. We're kind of at, I think, a kind of a junction point in the market here, where we're looking to kind of put a floor underneath what's going on here, because if we drop further, there's going to be, I think, some distance that we can drop further, and that's not necessarily pleasant. Um, we can certainly find. I'm certainly a fan of shorting and everything, but on the other hand, everybody's got their retirement plans and their longer term holdings, and basically everybody's long term holdings are long. So in the bigger picture, I'm happy to see the market go up. Having said that, with any number of great short trades can happen, but those are trades. They're not they're not your big pile of money. So for all the above reasons, I would like to see a floor get put in under here. So I figured I would take a quick look at the market though, and we'll kind of look at that. Um, so here's where we are now. And let me just make sure something here before we get going here. Okay, so Ryan is not here at the moment. He is lurking in the background though, and so I just wanted to make sure he was around. So
That's a good word. Yes, I'll mind the entrance, Mitch, and but guys, Mitch will be taking the lead. I'm responding from my phone and taking my wife to a doctor's appointment today, so just hanging out.
At any rate, so here's where we are on the SPY. So we're looking at the daily chart of the SPY here, okay? And so here's where we are now. And you can see, and let me just drop this down a little here. Um, we're now sitting at this point where there is some demand here. I'm not exactly in love with it, because you can see that immediately preceding it, there was kind of sort of sloppy demand here, where this kind of a sloppy drop based rally. Price came up. Right here, there's actually if that wasn't here, this is an awesome formation here, because we have if we blow this up here, let me just enlarge this here. You'll see very clearly that this is, sorry, this is the formation that I always like to talk about, where we have the decisive. In the case of a demand zone, we have a decisive bearish candle that kind of creates the entryway. Okay, then we have these indecisive candles, and again, indecisive candles are primarily wick, where a decisive candle is primarily body. Obviously, this is very much body, like 95%, 96% plus. Okay, and these, of course, are primarily wick, and then we have that explosive rocket ship out of there. So this is a super formation on its own. The problem where it loses some points is that right before this, there is essentially trading at more or less the same level here. And so as a result, this is in a sense not really a fresh level, because you can see that huge amount of overlap. Now, having said that, does that mean that this thing is worth nothing? No, of course not. But this becomes a little lower probability though. So you can see now prices come back here. Okay, and you can see it's basically, pretty much stuck right on that front line there, which is based on this being the candle in control. And in fact, actually, it was kind of a, see, this is the candle in control here, because this is the candle that trades the lowest, right? So this is where I place the back line of this demand zone, and then I used essentially the full range of the front to form the front line here, of that very top of that candle in control. Okay, so that's the thing that defines that demand zone there, and you can see that's a little less than five. That's a little less than 5 points there, going from about 568 to about 572 and a half. So that's about like 4.5 points. So that's what we're looking at now. Now, one of the things that I do like about this, in addition to the zone, which, like I said, does lose a couple of points because of this preceding trading, but to some degree, to sort of, maybe on the plus side to make up for some of that, we've got two odds enhancers that are going on in here. Okay, and so right here we have, this is the lower standard daily Bollinger Band, okay? And the Bollinger Band, as we've discussed before, is based on the 20-period moving average, simple moving average, and then above and below it, without getting into the statistics of it, but this is a two standard deviation line above and two standard deviations below. Okay, and so the thought being that if price would drop below this one, it means that price is very stretched to the downside. And statistically, there is a tendency for things to revert to the mean, a high percentage of the time once you get below this. Having said that, I would never just trade because something went below this. But you can see any number of times, like right here, it came here and it did just bounce off. Obviously it needed to give a little room. Okay. You can see right there, it came down, it bounced. Okay. So quite often it will do that. But more often than not, it does it because of the fact that there is also in vicinity either a quality demand zone or a point of resistance. It's not necessarily that it's literally reacting to this, but this oftentimes directs your eye to look for formations in the chart that do suggest a bounce. Okay. So right here we have that lower Bollinger Band. Okay. And then the other thing that's going on, and this is actually even more important here, is this. This is the 200-day simple moving average. And we've talked about this, any number of times, that if you watch CNBC or, look at Bloomberg or, just even, just read about anything, in finance, when people go to the charts, there is essentially two things that they look at. They look at the 50-day simple moving average as kind of an intermediate moving average, and they look at the 200-day as kind of a longer term moving average. And 200 days, of course, would represent that's about 10 months in terms of trading days. Okay, because of course, when we're looking at a chart here, everything is about trading days. Okay, so there's 252 trading days in the year once you knock out weekends and holidays. So 220 would be about 6 weeks worth, six weeks less than that. So this is about 10 and a half. So the 200-day represents about 10 and a half months of trading, or call it, let's say, about 10 months. Okay, so you can see we're coming right down to the 200. Okay, so we're already below the lower Bollinger Band, and we're at a kind of, I'll give it a B. We're sort of at a B rating demand zone because of the fact that it's not a fresh level anymore. Having said that, we do have, the good formation there, the rally, the drop base rally. We have that gap, and then it goes. So, it is a reasonable demand zone. It's just a lower probability demand zone. Okay, so now we got those three things going on. We've got the 200-day, we got the Bollinger Band, and we got the demand zone there. Okay, so those are the positives. Now, what's negative though is if in fact it blows through here after all of that, that's the thing that kind of gets a little scary, and that's the thing that kind of gets people's their anxiety up here, because of the fact that we do have all this stuff going on here. If it blows through here, well, then what happens? Okay, so I kind of map that out here as well. So let's take a look at what's below here now. So let's just grab that and slide that over here. So again, here's the origin of that point of resistance. Okay, so now here's where the next kind of the next stop here. And I'm not necessarily in love with this, at least in the daily chart. I would probably go to refine this here. I would probably, break this down into a 2-hour level. And then similarly down here, this is also a point. And this kind of shows up very nicely and very clearly here. Okay, this is probably actually, even just on its own, is probably a great base rally here, just sticking to the daily chart without even, breaking it down further. Okay, and so that's sitting right here. And let me just change the color on it just so we can differentiate it. And then what I'm going to do here in terms of what I'm going to do is I'm going to put a distance. I'm going to essentially put a yardstick on this, and let's just see how far down below are we from where we are now, and that'll kind of give it. So now we'll have an idea that if in fact the market let's just say it happens to break through where it is now, what might it do, further down, and how much further down would it go? So let's take a look here. Okay, so there's kind of a really quality level. And this is probably a reasonable level if I probably break it down, let's say to a 2 hour chart or something. And the reason I'm concerned, and Ryan talks about this all the time, is this preceding this wick here. Okay, that's always that's always problematic. Having said that, though, okay, what's the direction of this wick? It's just rockets up. This is about as bullish a candle. You basically have this lollipop candle here, the popsicle stick, and you can see it. This closes right at its high. So even though I'm not thrilled with this, I still, what might happen is if price would get back here, you might actually see it dig a bit into the zone, or even substantially into the zone. But then after that, it might just rocket right out of there, because that's what it did before. Okay. So at any rate, though, those are the two levels that are kind of below where we are now. So if we kind of go back and then put a yardstick on this, here's where we are. So what I'm going to do is I'm going to throw this over here, and we'll drop that down here, and we'll measure that out. Okay, so you can see right here from where we are now to that's about 4 1/3% from where we are now. A little over 4%. Okay, and then if it would break through that, then of course now we're gonna then we would end up back here. Okay, and then that's actually about in the 7% range. That's a little less than 7%. Okay, so those are the two areas. In fact, what I'm going to do is I'm going to put one here. We'll put another one here. And then what I'm going to do also is I'm going to measure this out. And this will help you kind of, let's say if you happen to watch, put on, CNBC or something, and they start talking about stuff, you'll have some insight about this when they start throwing around certain terms. Okay. So right here from where we are now, that's 4.5%. That's a little less than 7. And from when we go back to here, which is our 52-week high, and I guess this was an all-time high, I guess, at that point. Okay. If we go all the way back to there, and let me just throw one more of these on here. Okay, so here's what we've done since hitting that all-time high. Okay, we have now dropped basically about 6.5%. Okay, there's that 6.5% from there. Okay, and so if we would continue on down right here, let's get to the 10% mark, which is pretty much going to be right here at this right here. If we would end up down here, this is where we're at a correction. Okay. Okay. In terms of official terminology, this would be considered to be a correction. Okay. A 10% move off of the all-time high, or in fact any sort of local high, that is considered to be a correction. Okay. 20% would be a bear market. Okay. So that's where we are now. Okay. So just in context, right now we're down about 6%. So we're a little more than halfway to a correction. Okay. But right here, the front door of this somewhat imperfect demand, actually, well, it's actually not bad demand zone. So the front door of this demand zone there, that's at correction territory. And then of course, right here, we're well into correction territory. Okay. If we would actually get to that second level, then we'd be down probably on the order of about like 13% or something like that. 12%. It's almost 13. So in context, that's kind of what that's where we are now. Okay. So this is what everyone's kind of keeping an eye out. So this just to put in, so now if you're watching CNBC or Bloomberg or whatever, and they start throwing around statements about corrections, bear markets, all that kind of stuff, that's what you're looking at right here is kind of what they're referring to. Okay. But again, in terms of the floors, where, places where we could, reasonably expect, some stability to come in, these would be the locations right here at around, kind of, let's say, call this about around the 570 area where we are now. Okay. And then after that, we're kind of in that 545 area that's here. And then right here is about that 530 area. Okay. So these are the places that we're going to be kind of looking for kind of guidance and stability. All right. So I figured I'll just kind of go through and kind of do a little market analysis here. All right. So there you go for that.